Hello and welcome to an FX Times daily video recap. I'm CMS Forex market analyst Nick Nassad. Today is Wednesday, December 23rd, 2009. In today's session, we saw the dollar consolidate some of its recent strong gains as it declined against the euro and the yen. As investors perhaps took profit before the Christmas holiday. The dollar was pressured by a weaker than expected housing release, which cast a shadow over an otherwise brightening U.S. economy. So investors seem to have taken that first batch of disappointing U.S. economic report in some time as an excuse to book profits, especially heading into the holidays. Still, it'll take more than just that data to dim the newfound enthusiasm around the U.S. recovery, and this looks more to be just a period of consolidation. We found some support overnight around the 1.4230 area, which was higher than our low from yesterday. Then we ran up against some resistance in the form of our moving average and also power line that if we connect our lows from earlier in the week, we see that this point here around the 1.4275 area was important, and with the new home sales release coming out around that time, which was disappointing, we saw the euro move higher, reaching its high from Monday's trading. The pairs rally stalled out around there, and we end the day around a little bit above the 1.43 area. So that's pretty much where we started the week, in fact. We saw a similar dynamic in the dollar-yen pair, which for the first time in 7 sessions moved in favor of the yen. We retested our resistance from yesterday, but were unable to penetrate that 91.90 area, and we did have some consolidation or sideways movement in today's session. In data from the US, we saw personal incomes for the month of November rise 0.4%, a figure that was the highest in 6 months, though it did come in a bit lower than the expected 0.5% increase. Also, personal spending rose 0.5%, again slightly lower than what was expected. Still, the spending number is a good one and follows on reports in retail sales and motor vehicle sales that were strong for the month of November, and so personal consumption was meant to go up. This is the figure, personal consumption expenditures, that is the main component in assessing consumption when measuring GDP. If we take a look at our chart on the right, we see that we moved into positive territory in terms of the annual pace of consumption in August, when we had a very strong surge in response to the end for the Cash for Clunkers program and an increase in spending on automobiles. That was followed in September by a rather sharp decline, but then we've had 2 months of relatively modest gains since then. So that has kept the annual rate increasing heading into the end of the year. Durable goods, such as cars, rose 1.1% in today's report, while non-durables were up 1.5%, which was better than the reading we saw in October, where we had a 0.3% increase. So what that tells us is we had a bit of a broad consumer spending in the month. These figures were mainly expected by the markets, and so when they came out, they didn't have too much of an impact in currency trading. Also from the report, we had measures of inflation that the Fed officials really like to look at, the PCE price index, and the main one that we're interested in is the core PCE price index, as it excludes volatile items such as energy and food. And what we saw was a flat reading in November, which was softer inflation than we saw in October, and also lower than what the consensus forecasts by economists. Looking at the annual core CPI rate, we see that it grew by the same amount as in October, rising 1.4% for the month. Moving to our next release, we saw that new home sales for the month of November slid rather sharply to an annual pace of 355,000. That was much lower than forecasts and an 11.3% decrease from October's figure. That figure was revised sharply down from 430,000 annual pace to a 400,000 annual pace. So both October and November disappointed in terms of new home sales. If we take a look at our chart on the right, we see that following a rebound in the first half of the year in new home sales, we're now in a bit of a downtrend as the last 5 months or so have seen declining sales. There are two factors likely at work here. Home buyers, first of all, might be looking for cheaper bargains, and rather than purchasing new homes, are deciding to buy existing homes. As we saw, the existing home sales pace rise 7.4% in the same month. Also at play was the looming expiration of the government's $8,000 new home buyers tax credit. Since new home sales are recorded with the signing of the sales contract and not the actual closing, those buying homes in November may have been worried that they would miss the end of the month cutoff and would not apply for the tax credit. So that may have contributed to the sharp decline we saw. The data caused a dip in U.S. stocks, but throughout the rest of the morning and afternoon New York sessions, equities did manage to rally and broke above into positive territory by the market's close. While the pound-dollar pair traded rather flat and sideways today, the euro-pound did rise in favor of the euro as sterling was pressured by Bank of England meeting minutes, which showed that Bank of England policymakers unanimously kept their bond purchase plan at $200 billion. Pounds, as two policymakers that had voted away from the consensus in the prior meeting conformed in the meeting held December 9th and 10th. Those changed votes were from Spencer Dale and David Miles. Dale had wanted to limit the purchase plan to a smaller $175 billion in November, while Miles argued for increasing the plan to $215 billion, which gave the MPC a three-way split. This time there was unanimous consensus, and it seems that the bank is in a wait-and-see mode until it puts out its new quarterly growth and inflation forecasts in its February meeting. As you can see, we had 3 days of euro strength against the pound, which counters some of the euro weakness we had seen throughout most of December as the euro was pressured by credit concerns. However, we did see a bit of support setting up prior to this week, and the euro has managed to pair some of this slide here. We're now testing the 0.90 area, which had acted as support prior to our break in last week. So this line here, and if we extend it, we see that we are approaching that level now, and that is where we hit our high in today's trading. Also today, Canada put out its monthly measures of GDP growth for the month of October, and it showed that the economy expanded 0.2%, which was slower than the growth rate in September and also weaker than expectations. Despite the weaker than expected GDP report, the Canadian dollar still rose for a fourth straight day, as it was boosted by Canadian Finance Minister Jim Flaherty's comments that he wouldn't be surprised if China and Russia bought the Canadian dollar to diversify their currency reserve holdings. Also, we saw oil futures rise, which supported the Canadian dollar as well, after we had U.S. oil and fuel inventories drop by more than expected. We managed to break this upward sloping line of support, and we had seen all week that the Canadian dollar was stronger even as the greenback had been gaining against most of its other rivals. So today's move in favor of the Canadian dollar seems to be a natural extension of what we had seen earlier in the week. Now let's take a look at what we can expect from the fundamentals in the upcoming session. Tonight, Japan will post its BSI Large Manufacturing Index along with meeting minutes from the Bank of Japan. Tomorrow, the U.S. posts data on jobless claims and durable goods, while tomorrow evening, Japan posts its end-of-the-month reports, including household spending, consumer prices, its unemployment rate, its measure of inflation for corporations, and also housing starts. On Friday, the Forex market will be closed. And that will wrap up today's video recap and our coverage of the Forex market for the week, as there will be no video recap tomorrow or Friday. As always, you can check fxtimes.com for more news, videos, and analysis. I want to thank you for watching, and I wish all of my viewers a happy and Merry Christmas.